Welcome back to my channel. I am Kristen Van with Fantastic Finances, and on this channel I usually teach velocity banking. But today I have a very special guest. Chris Naugle is with us, and I am so excited because I have so many clients and people reaching out from YouTube saying, what do I do with my money? I'm out of debt now. What do I do with my money? And you may not be completely out of debt, but you want to look into savings and what you need to do. So Chris is here going to show us all about infinite banking. I get those questions. I'm telling you guys, you're going to be very informed after you see this video. So if you have any questions after this, there's going to be a link, a phone number, I believe, and you're going to have answers to everything you need to know. I want you guys to sit and listen to this guy talk because he has convinced me multiple times of what he does is excellent work. He has a great work ethic, and he is so knowledgeable in how to take care of your money. And that is the only reason he is on here, is to share that with you. Chris, welcome to the show. Thank you so much for coming on today.
Oh, thank you for having me on. It's an honor and a privilege. I can't wait to serve your audience. I mean, we've watched some of your stuff. My compadre here, Lazy Cash, to be on your show and teaching something that I've been using for a long time. It's changed my life and for our clients, about almost 10,000 people's lives in the U.S. alone.
Wow. How did you get started? Because I know you talk about you've been a financial advisor.
Yeah, so I didn't learn this being an advisor, and I spent 16 years as an advisor in Wall Street. They never once showed us anything about this. So how I actually figured it out was by mistake. I got into real estate after the Great Recession, and after the Great Recession, I almost lost it all, almost went bankrupt. I owned skateboard, snowboard shops that I started when I was very young, started a clothing line that turned into a retail store, PHAT. I was 16 to 17, and that's ran those shops all the way up until 2010. Now, when I sold those stores, I pivoted. And instead of, doing the advisory stuff, which I continued doing, but I sold the shop. So I took the time that I used to spend in the stores and started working in real estate. And I started buying investment properties and apartment buildings. And all that was going great until 2014. But in 2014, the bank flipped on me. They froze my lines of credit. I never really understood how banks worked in terms of issuing credit and issuing mortgages. The commercial loan officer said, we can't give you any more loans. You don't fit in that little square box called the debt to income ratio box. So I had to figure it out. Instead of rentals, which we sold most of those, we started flipping houses, my wife and I. And we started using private money, which I'll talk a lot about private money and Private Money Club today. But back then, I was a pioneer. I was brand new at this. And I knew this guy, Mike. And Mike's pivotal in my life. So I'm in Salt Lake City because I was a pro snowboarder during this period of time, and I was snowboarding and doing something. And I called Mike up, who lived out there, and I said, Mike, I got a deal I'd like to run by you. So he said, meet me at Cheesecake Factory, and I met him there, and I just asked him, we were sitting down for lunch. I said, so how do you fund all these deals, Mike? And he says, I fund them from my private banking system. Wait a second, Mike, you got yourself a bank, man? I didn't know you were rolling that deep. You got a bank? And he tells me, no, I don't have a bank, but, I have a banking system that I've set up. And he starts telling me about this banking system. He's like, well, I get guaranteed interest for the rest of my life. I'm like, the heck is this? And then I get dividends every year, and I can use the money. I can take the money I put into my private banking, and I can lend it to you. And that's what I do, Chris. I lend it to you at 12, 13, 14%, and then you pay me interest, and I take your interest, and I put it back in my private banking system. So as an advisor who'd never heard about this, my mind was blown, but also I was skeptical. And he tells me what it is, which I'm going to hold off on that because I'm going to get into it in the presentation, but he tells me what it is, and I had a misconception. I thought I knew what I didn't know about this vehicle. But when he started explaining, I had to make a decision, like, who's right? Like, my mind and what I think I know, or this guy who's actually doing it? So I said, Mike, you got to teach me how to do this myself. And he says, I can. I learned from this guy, Brent. So now you know Brent, and that's how I got connected with Brent Kessler, because after I left lunch there, I immediately called Brent, and I started just rambling off all this stuff that Mike had told me. And Brent's like, whoa, hold on a second. Have you watched the 90-minute video? And I said, no, I'm an advisor. I don't need a video. I just need to get this started. Like, this is incredible. And he said, you have to watch the video. And boy, I'm glad he did that, because I was missing so many pieces along the way on how this worked. So I watched the 90-minute video, booked a call with Brent, started my first banking policy way back when, and I've never turned back. I've used this for everything in my life, and now I just teach it to, gosh, hundreds, if not millions of people. Hundreds of thousands, if not millions. Yeah, I don't know how many it is now.
That is awesome because when I heard you and you'll have webinars and stuff, so I've been a part of those. It just makes all sense. I mean, the infinite banking, the velocity banking to me, but all the infinite banking, that's just like common sense. And it's amazing that we were not taught that. I talk to people every day about infinite banking and about you because I'm like, chrisnoggle.com is where you need to go. He teaches everything you need to know, not just about infinite banking, but with the Private Money Club. That's awesome in itself. And I had to have you on here because the way you put it into words, just like you just did, it makes all the sense to me. And it gets me excited because I know people can be planning somewhat of a retirement while they're throwing money in to turn around and use again. That's what's so nice about the policies. They're liquid. I want you to go into presentation because I want to hear it again. I'm excited. By the way, guys, have a policy with Chris myself. I wanted to go through his group first before I presented to you to know how they work and how they set up. And it's excellent. I mean, it's the easiest policy I've ever had set up. I have 5. And it's the easiest one. It was just cut and dry. You do this, they do this. And I mean, they get on it. And within 30 days, my policy was done, ready, set up, and I started making deposits. So it's the real deal. And I want to share it with you. I want you all to realize there are other ways to take care of your money than throwing them into these retirement funds, throwing them into the stock market where it's risk, risk, risk. I want you guys out of that, and I want you into financial peace. And I really believe that Chris is going to help you with that today.
I'm very excited. And I put this together just for your audience because there's such a correlation between velocity banking and what we do with infinite banking. I mean, really, they're 2 peas in a pod, and one translates to the other. They just work in perfect harmony. And I'm very excited to show your audience exactly what it is we do, how we do it, and a lot of really fun stuff. We're taught to work for money. We're taught to go out there, trade hours for dollars. I don't care if it's high school, college, trade school. That's what they teach us to do, that your hour has to have some monetary value. And we go through life believing this. I'm no different than you, and my daughter will be brought up through the same system that all of us have. And my daughter's only 3. She will be taught to give up her most valuable resource she has, and that is her time. And folks, what I think the most important thing that I get across to all of you is that this isn't a business of making more money. This isn't a business of, making your money work for you. This is a business of me teaching you how to take your time back, because that's what matters. I can show you how to make millions of dollars. I can show you how to be independently wealthy and never give the money back. But the most important thing that money must do is it must work for you. Because if money doesn't work for you, you are working for money. And that means less time for you to spend with your family, your children, and those memories that are generated from the time you spend with loved ones are the things that you will remember in your final breaths. You won't remember the cars, the Porsches, the houses, and all the things that money bought. You'll remember the time that you spent. So I think it's important in the beginning of this presentation to clarify and quantify what it is I want you to get out of this. And I want you to understand that what I teach is very simple. I teach you how to take back control of your money by teaching you how to become your own bank, BYOB. In doing that, the single solitary goal of that entire thing is time. Because without time, what's the point of the rest of it? You need time back. And I will show you exactly how to do that. Now, let me just hit some of the bad things. What I'm going to teach you is probably something that you've never seen before. It's something that's going to challenge every thought you have been taught up to this point about money. I'm going to teach you that everything you've been taught, for the most part, has been a lie. And I think you're probably already prepped from that because Christy, I'm sure, has brought that to your attention. You have been taught to give up control of your money. Hence, why so many people have 401ks, why so many people give money up to brokerage accounts, to Wall Street, to financial advisors, because they feel like they can't do it themselves because they've been taught not to. Today, you are going to have to do a 180-degree Okay, you're going to have to go 180 degrees mentally to really wrap your head around this. What I teach and what you're going to learn is not hard. It involves one change, folks, one change. And that one change is this simple. If you can see me, I'm holding a couple $100 bills. The change is where this tool called money goes first. That is it. That's all we need to do is change where our money goes first. So with that, I think all of you are thinking, whew, I thought this was going to be complicated. I thought this was going to be hard. Nope. One change, folks. That's all it is. And for you, however old you are, I'm 46, for the majority of my life, I was never shown this one change. And then once you change that one thing, where your money goes first, we have to add one step. So that's it, folks. All of you right now can just take a deep breath and relax, because that's all we're doing. We're changing one thing, where your money goes first, and then we're adding one step, and that's how your money works for you. And the sole goal of those two things are to give you your time back. And then we're going to dive right in. The number one thing I have to get you to understand is the banks are not your friends. You need to become your own bank. The infinite banking concept is not a product. I'm not here to sell you a product. I'm not here to sell you anything. I'm here to teach you how to take back control of your money, because this process called the infinite banking concept, you can look it up. It was pioneered by the late R. Nelson Nash, is not a product. It is a process of you taking back the banking functions in your life. So a lot of you hear that, but you don't really articulate that. So on the screen, I've got the 5%. Every one of you are the 5%. You may not know that, but you need to understand that. Because Earl Nightingale, in his famous talk, okay, the strangest secrets of the world, he talks about the difference between success and failure. And I think this little slide here sums that up. The difference between you being successful and you failing comes down to one thing, and that is creation. You need to create the future you want. You need to create the future financial destination you want to be at. You need to create the life you want to live, and you need to follow your dreams. If you don't create that, then the alternative is failure. And you know what failure is created by? Don't get mad at me for saying this, but it's conformity. You conforming to somebody else's failed plan, somebody else's failed financial destination, somebody else's failed dreams. How many people in your life have told you you can't do something, you shouldn't do something, that's a scam, that's not real, folks? If you believe them, you're believing their failed reality. At the end, and I got to give it to you now, I'm going to show you a slide. It's Will Rogers, and he says this. He says, the biggest problem in America is not what people don't know. He said the biggest problem in America is what people think they know. That just ain't so. I need you to stand up and be counted. I need you to understand that you are the 5%, because the other 95%, they're not here. They're not listening to Christy or me. They're out there thinking they know something that just ain't so. And I'll prove it to you right now. This is Social Security. This is pure numbers from Social Security that go into what Earl Nightingale talked about, I believe in the 30s and 40s, maybe it was the 50s. It doesn't really matter. He understood that it was that simple, the difference between success and failure. Create versus conform. 5 out of 100 people will be financially secure at the age of retirement. Let me just let that sink in a little bit. 5 out of 100 people will be financially secure at the age of retirement. That means that 95% of every person you come in contact with will not be financially secure at the age of retirement. But the good news is you will be, because you're listening to Christy. You're taking back control of your money. Money and the velocity of money is working in your favor every single day, so that you can go out there and enjoy your life because your money's working for you. The velocity is now in your corner. You've heard enough about me, so I'm not going to really give you too much more, but my background is I would say, interesting. I didn't grow up with money. My mom allowed me to be a dreamer as a kid, but she didn't have money, so we had to create fun. We had to create what we wanted, whether it was ponds, BMX bikes, skateboards, everything I had to create, because we couldn't just write a check or go out and pay cash for these things. I had to work for them. But the other thing, too, that was very interesting is where I grew up is in Buffalo, New York. I still live here. Sometimes I ask myself why, but the why is because my mother's still here and I'm all she's got. But I wanted to be a pro snowboarder. Every single person told me that wasn't possible. Even family members, not my mother, but everybody else in my family said, well, you can't do that. There's no way you can do that here. You'll have to move. You'll have to do this. All the people in school, nobody believed in the dream. But I did. And my mother allowed me to dream. I did what everybody else was unwilling to do. And I did become one of the three. And there's only been three throughout the history. There's only been three snowboarders that have gone professional from Buffalo, New York. And I am one of those three. So when people tell you you can't do something, folks, I'm living proof that you can. The snowboarding career led me into my retail stores, which you already heard about. My retail stores then were like living a dream. But that dream came to a halt in the early 2000s when the planes hit the tower. When the dot-com crash kicked in, I had to get a job. Well, Little Caesars, truthfully, was not hiring delivery drivers because that's what I thought I would do, deliver pizza. I put my resume out. It fit on one page. That tells you a little something. It's not like I have an awesome background in all this education. I didn't go to Harvard or Yale. I'm just a normal kid from a normal small little town with a big dream. And you know who replied back to that resume when I sent it out? Wall Street. You see, Wall Street is always looking for that self-starter, that entrepreneurial mindset, because what they do is they break you down and they rebuild you to what they want. And that's what they did with me. 16 years of rebuilding. I don't know if that was good or bad. It gives me a very interesting background when it comes to money and investing that most people in my field do not have. But it also led me down a path that had me doing the exact opposite of what you actually should do. And the good news is I left Wall Street in 2018. I retired. I sold my practice. And me and my wife had a TV show on HGTV right there called Risky Builders, aired in 2018. Ever since that TV show didn't move on to series, I've done nothing but go around the country and teach people the infinite banking concept and how to take back control of their money. And that's exactly what I plan to do. There's the man right there, Will Rogers. There's the quote. Take a picture of it. The problem in America isn't what people don't know. It's what they think they know that just ain't so. Why did I say that twice? Because I know, because I've done this thousands of times, I know for a fact there's going to be some of you that watch this video that are going to think that. They're going to think, oh, there's no way that's possible. There's no way it works that way. Well, folks, it isn't what you think. Sorry, I'm screwing that up. It isn't what you don't know. It's what you think you know. And that's what gets you in trouble. So I always like to kick these webinars off with the mysteries of money. And I bet you any money, as you watch this and as I go through this, some of you are going to have troubles with these mysteries just like everybody else does. And the very first one is, what is the definition of money? Just think about that for a second. What is the definition of money? A lot of people don't know, but it's simple. It's a means of exchange. Money for food, food for money. Money for house, house for money. Money for car, car for money. That's all it is. You just exchange it. Yes, we use dollars, but in other countries they use wands. They use, all sorts of different currencies. Gold, silver. Throughout history, money, it doesn't matter what shape and size it is, has always been a tool to exchange. That's all it is. So moving on to the next one, we'll get a little bit more complicated here as we go down these mysteries. But what company in the world, and I notice how I threw world in there, what company in the world uses compound interest? And when I ask this in an audience, doesn't matter how big or how small it is, someone, actually usually a lot of them, say banks. They always say banks use compound interest, but they're wrong. Banks don't use compound interest. They charge you compound interest. They pay you compound interest, but banks do not use compound interest. And I can prove that because when you walk into the bank and you take the money that you traded hours for and you give it to the teller, what does the teller do with your money? Do they take your hard-earned dollars and put them in a little box with your name on it and put it back in the vault? You silly rabbit. If you haven't heard by now, there's no money in the vault. That's why Silicon Valley Bank and Republic and Signature all went belly up. There's no money in the vault. It doesn't work that way anymore. So what do they do with your money? They take your money and, well, if you just look around when you go in the bank, you see all those cubicles, those little offices? They move your money. They put your money to work for them because you allow them to do it. That is the single solitary reason they're able to do what they do. It's because you allow them to do that. When you open a checking or savings account, do you read the fine print? You are giving control of the hard-earned tool, the money that you earn. You gave up control of that money to them. And because of that, the bank can go out there and use it for anything that they want. And we'll go into that in a little bit. But I'm just trying to get you to start thinking about what's really going on. And this is where it begins. But are your dollars, the dollars you have, are they worth more now or in the future? Any of you that said now, you're absolutely correct. And any of you that just went through this inflationary period we are still in, you know that things just got more expensive. But you see, things didn't get more expensive. That's a myth. Your dollars got weaker. Your dollars got weaker, and it's called inflation, but inflation is really a hidden tax. That's all it is. When they print a dollar, they have to derive value from somewhere. So where do they derive value from? Your dollar that you're holding in your wallet or wherever you have it in the bank account. And every time they print another dollar, it strips another piece of value from your current dollars. And if you can see me, I am tearing off pieces of a $100 bill right now. Yes, I'll tape it back together. But every dollar they print steals value from your dollar. So when you have this money, it's not worth as much. Therefore, it doesn't buy as much. That's what inflation is. So of course, your money's worth the most today, which begs me to ask the next question. Taxes. Are they going up or down? Now, you already know this. This is a giveaway. They're going up. They can't go any lower. They're at the lowest point they've ever been at. So with all this printing and everything else, how are they going to pay it all back? That's right. They're going to tax you. Oh, and by the way, when they said that they weren't going to tax those that make $400,000 or less, that was the biggest joke. And my kitty cat just wants to be part of this presentation, but he is going to be pushed off. So think about the biggest tax that we just went through. It wasn't that your taxes went up. They didn't raise your tax rate, but they certainly taxed you when they printed $5.1 trillion, because now your groceries doubled. Your fuel prices went way up. Everything that you touch, everything you buy, it doesn't cost more. It just takes more dollars to buy them. That is the tax. So taxes always go up, folks. Don't ever, ever think that taxes will go down in your lifetime. Retirement accounts. We talked a little bit about this. Christy talks a lot about 401ks and IRAs. I just want to go through everything we just discussed. Money is a means of exchange. What company uses compound interest? We're the only ones that have been taught to use it. And to get compound interest, what do? We take our money and we park it somewhere and we just leave it sit. And that's what we think has to happen to earn compound interest. But I told you, banks don't leave money sit. They constantly move it. It's always in motion. Every business in the world puts money in motion. Don't believe me? Car dealerships. What do they move? Cars. What are cars? Inventory. What does it take to buy inventory? Money. Their money's in motion. Grocery stores. What do they buy? Food and all the stuff you see at the grocery store. What do they do with that? They move it off the shelf. Their money is in motion. It is not sitting still like our money. So why in the world, if our money is going to be worth the most today, would we ever take our most valuable dollars and put them into a retirement account, a 401k? Why would we put our money there? Then we have to wait 5, 10, 15, 20 years, depending on your age, till you're 59 and a half, to be able to actually use that money. We gave up control of that money for that period of time, because the last time I checked, in order to take the money out of a 401k, you got to pay an early penalty fee of 10% before 59 and a half, plus taxes. And I know some of you are saying, yeah, but you can take a loan. Yes, you can, up to $50,000 or 50%, whichever is greater. See, they're controlling how much of that money you can use so that they get to take that money and make it work for them. How does Wall Street make money? It's called a spread. How does everybody make money? Fees and spreads. How do banks make money? It's called a spread. It's all about the spread. They pay you 4, they charge you 8. In the middle is the magic number called a spread. Get that straight, because that's what you need to do. You need to learn how to be the bank. Because if you learn how to be the bank by changing one thing and then adding one step, you and your money will continuously, for the rest of your life, earn a spread instead of them earning a spread. Again, folks, I was just trying to get you to start thinking about what's going on out there. And before we get into the infinite banking concept, me and Christy talked offline a little bit about a problem that many of us have. Sorry about that. And that problem is we got too much money sitting in retirement accounts. Yep. Those things called 401ks. How much money sitting in them? Last time I checked, it was like $41 trillion is sitting in 401ks in this country alone. 41 trillion. Maybe it's 38, maybe it's 44. No one's really counting, but that's a lot of money. Now, I like giving case studies because I think it's the easiest way to portray someone and explain to them how to be the bank and take back control. You see these folks right here, Chuck and Mary Jones. They're real clients. They are real people. And they had real 401ks. That's right. These are not made up people. We call them the Bank of C&M Jones. Why? Because they became the bank. You see, they changed where their money went. They had 401ks that they rolled over into IRAs when they left, okay? And they had 10 years till retirement. Now, 10 years to retirement, but they only had $350,000 combined in retirement assets. I just want you to all think about that real quick. $350,000, they've got 10 years, and they want to retire. And they wanted to retire with a good amount of money per month. Now, if any of you were to do the math, $350,000, well, that's just not going to get it done. I know they got 10 years, but if you use the rule of 72, if they make 7.2% on that 350 grand, their money's going to double once in 10 years. So what do they got now? 700 grand? Is that enough to retire on? I'm sorry, not even close. They will be broke and out of money. So they had to figure something out. And they didn't want to have an active role in their investments. They didn't want to learn how to manage their 401ks and IRAs. They didn't want to become stock pickers or derivative traders or future traders. They just wanted to go out and hang out with their horse and do the fun things that all of you want. They wanted time. So what we did is we showed them how to take back control and how to move their money. We didn't move it into the infinite banking concept. Remember, I said I'm not there yet. And this is not telling you to put money in retirement accounts. This is just for all of you that, like me, had those old 401ks out there and you don't know what to do with it and you don't want to cancel it because then you got to pay taxes. So what are you going to do? Well, they moved it to a self-directed IRA. Okay, I don't sell self-directed IRAs. I'm just telling you what we did and what they do. And by doing that, they were able to take that money and become the bank and lend that money out. And that's exactly what they did. They took that 350 grand and they started loaning it out, just like a bank does. Just like when you go to a bank and you get a mortgage, they did the same thing. You see, they lent their money out on real estate deals. Okay, and they did that and they made 9% on their money, flat, 9% fixed on their money in a first lien position, which means, just like Ricky Bobby and Talladega Nights says, if you're not first, you're last. You always want to be in first position because then you don't have to answer to anybody. The person doesn't pay you, you take the property. You never had to. They made 9% on that money, and they continued to fund those IRAs right up until the day they retired. So by doing just that, by funding them at the max, back then was $6,500 each. They put $13,000 into each of their IRAs, their self-directed IRAs. They let it grow for 10 years over at 9% because they really didn't have much of a choice with the retirement funds. That gave them $1,026,085 for retirement. Now, most of you, when you look at that, they say, wow, that's a lot of money. They're millionaires. Yeah, but $1 million doesn't get you very far when you retire young, which they did. But let me show you what actually happened. You see, they continued being the bank. They continued lending that money out at a rate of 9% on an average. They get far more today. I think they're at like 12 or 15% today, but that's because interest rates went up. Back then, rates were low. Which 9% on $1 million gives you $92,000, $76.95 a month. Someone can retire on that very comfortably, plus Social Security. But the best part is, folks, they never touched the principal. When the whole stock market goes down, which it did during the pandemic for them, nothing changed. Their income still kept rolling in. Everything was as it was. You see, folks, this is the power of you taking back control of your money. And stop, and just like them, when you stop giving that control up, you have a whole world of opportunity. And you turn the tides of the velocity. These folks, that's all they did. They took back control and the velocity worked in their favor because that's what the bank does. The bank takes the velocity of money and puts it in their corner. You just need to shift that. So now that you've seen that, let me go back to here. I think when I'm talking about being your own bank, this is an important slide because it references everything you already know to be true. So let's just hit some common ground. If any of you are business owners, I want you to just pretend that you own a restaurant. And if you owned a restaurant, you'd be proud of your restaurant because you were the proprietor of that business. You put your blood, sweat, and tears in. That was your dream. You created your dream. Which means when you create your dream and you're proud of something, you invite people in, right? You bring your friends to your restaurant. You bring your family to your restaurant. You share and you bring people into your business, right? We all know that to be true. Well, wouldn't the same be true if you owned a salon? You know, for any of you women or men that have barbershops, like if you owned a salon, would you ever go to your competitor's salon to get your hair cut? Absolutely not. That would look really silly. You know, you're sitting down getting your hair cut by your competitor. One of your customers sits down next to you and they're like, hey, don't you own the salon across the street? Oh, yeah, I was just checking out the competition. No, you weren't. Of course you'd get your hair done at your salon because you are proud of it. But a gym. Any of you ever been to the gym and not seen the owner of the gym? Never. The gym I work out at, the owner's there every day. They're not across the street at Gold's or whatever other gym there is. They're in their gym. So now that you can all agree that if you owned your own business, you'd be proud of it, you created your own dream, that you would want people to go there, but you would also go there and visit your own business and get the things you need from your business. So now let's just flip the tide. Let's just pretend that you owned a bank. Okay? It's your business. You started it. It was your dream. You wanted to be a banker. You wanted to own your own bank. The name on the outside of the building says your name. Underneath it, it says bank. So if you owned your own bank, where would you make deposits? Would you make deposits in Bank of America or your bank? Silly question. I think you already know the answer. If you needed a loan for a car, what bank would you go to? Of course, you'd go to your bank. And if you took a loan from your bank, would you make payments back to your bank of principal and interest just like you would with Bank of America, Wells Fargo, or Ally Bank? Of course you would. You would never steal from your bank. You would treat your money at your bank the same way you treat the money of another bank, right? You would, because you would be an honest banker, because it was your dream. It was your business. You can't let your customers see you stealing from your bank. You can't take loans from your bank and not pay those loans back. The board or heck, the regulators would shut you down. So if you own your own bank, then you are going to be an honest banker, which means if you borrow money from your own bank, you're going to pay your own bank back. But the beauty is when you own the bank, you set the terms. You're the boss. You get to pick and choose what the interest rate is. You get to pick and choose what the term is. If you got to miss a payment, well, you got to miss a payment. You go in and you look at yourself in the mirror and you say, hey, I'm having a rough time. I might need to skip a couple payments, but I'm going to make them back. And you know what you would do? You'd make those back payments because it's your business. It's your bank. Just trying to get you ready for what I'm about to teach you, because if I'm going to teach you how to be the bank, I got to teach you how to be an honest banker. And I got to teach you how to do the same things you do every single day, but how to do them with your own money and your own bank, which is exactly what these folks did. First guy right there, you probably should know him, Walt Disney. During the Great Depression, Walt Disney couldn't get a loan from a traditional bank to fund his dream, Disney World. So what he did is he took a loan from his private banking policy, which was a specially designed whole life, and it was from New York Life, just to actually go one step further. He took a loan, and that's how he started Disney World. How about the guy in the middle, Ray Kroc? Ray Kroc, you probably watched the movie Founder, but you saw at a certain point he flipped and he started doing real estate, and that's when Ronald McDonald came out. When he flipped into that real estate, he got a little pinch with money. Couldn't get enough money he needed from the bank. So what did he do? Well, luckily he had some old whole life policies that he used to fund that growth. Look at it. These are facts, and I've got a video on my YouTube that shows the history of all this. Doris Christopher, okay, Pampered Chef. She started that with a loan from her whole life policy. We can go right down through McCain. You can use all of the politicians, including the sitting president. Got 7 mass mutual policies that he used to fund, his whole marketing campaign, if he remembers that he's actually doing it. But nonetheless, you get the point. These wealthy folks all use what you're about to learn. So when people say this is too good to be true, it's a scam, how can it be? If we can go back through history and we can see the Rockefellers, the Rothschilds, the J.P. Morgans, the Stanleys, and then all these folks are using exactly this. Well, what is this? This is your own banking system, folks. So first, to do a banking system, you got to understand what a bank actually does. So let's just walk through it. It's kind of ironic. I love these slides. I've been doing this presentation so long that the numbers have come full circle. You see, back when I first started this, and I would put this up, I'd say, all right, so you work and you save $100,000 and you deposit that $100,000 in a traditional bank, and the bank pays you 4%. People used to laugh. They'd be like, there's not a bank out there that pays 4%. So I would say, oh, well, good. Then you found yourself a really good bank. Today, you actually can find a traditional bank that pays you 4%. I've literally gone the whole cycle. That's how long I've been doing this. But we all know that when you make a deposit in a bank pays you interest, right? 4%. But we already talked about this. What does the bank do? They move your money. They make your money go to work for them, and they lend that money out. And they lend it out on mortgages. Again, full cycle. 7% is actually a little low for today. Before, people were like, we got a mortgage for 2.5%, 3%. Now it is 7%, full cycle. So the bank lends the money out at 7%. The seller gets the money from the bank, okay, the mortgage, and the seller does what? Exactly what they were taught to do. They deposit the money right back in the bank. And round we go. The bank then moves that money and makes it go back to work and lends it out on that BMW M4 that you wanted to buy. And they charge you 8%. The banks give the car dealership the money. The car dealership does what they were taught to do and puts the money right back in the bank. Somebody takes a home remodel loan for that new kitchen, that new bathroom, and then they charge them 9%. Why 9? Well, because it's more risky, because it's now a second position. Remember, Ricky Bobby's dad said, if you're not first, you're last. But then at the end of the movie, he said, well, son, I never said that. There's second, there's third, there's fourth place. Heck, there's even fifth place. Well, when the bank goes down the line of what place they're going to be in on a home remodel loan, a HELOC, typically their second position, which is higher risk, which is 9%. Actual real numbers by today. Contractors get the money. Some of them put them back in the bank. Some of them don't. And then there's always the debt consolidation loan. And hopefully none of you are going out taking debt consolidation loans, because Christy shows you a much better way to take velocity back and pay off your debt. Some folks out there, they're not part of the 5%. They're that 95% that say this is too good to be true. It can't work that way. Never can, never would. My granddad said that's a scam. So what do? They go back to the traditional bank, take out a loan at 12% because there's no security, pay those credit cards off. The credit cards put the money back in. I just want to ask one question. On all these transactions, who is in control of every single one of them? Was it you because it was your money? It was your $100,000 that you worked for? Nope. You had no say in that. You didn't get to pick the mortgage, the car. You didn't get to pick the home remodel loan. You did nothing. You just got paid 4%. The bank was in full control of your money and everybody else's money. And then how much risk did they take to do all this? Some people say none, but they did take risk, but very little, because every one of these transactions, with the exception of the credit card, was all secured by an asset. Because lending works best when there's something that you can wrap your head around, wrap your hand around, that you can securitize the loan by, and that's what banks do. And in the middle of these numbers here, and let's go through them, you get paid 4 on your deposit, and the bank lends it out at 7. So what's that number in the middle? That's the spread, folks. That's how banks make the money. Don't get into fractional reserve banking. Let's just keep it simple for today. So the bank made 3 on that loan. They lend it out at 8 for that car loan. So what do they get there? Well, they get another spread, 4%. We'll go right around. 4 minus 9, they make 5% on that transaction. 4 minus that whopping 12% debt consolidation, 8%. How much money did the bank make? The bank made 20%. And how much did you make? 4. The bank was in full control, made the money go to work for them. So, of course, they made more than you. But how much did the bank actually really make? Because some people are like, well, the bank actually really made 20%. But yeah, you made 4 and the bank made 20. So how much more than you did the bank make by making your hard-earned dollars go to work for them? The math is right on the screen. In a live audience, I would ask everybody to tell me the number in a percentage, and very rarely does somebody get it right. But if we take 4 and we divide it into 20, what do we get? 5, which is 5 times more, which really is 500% more than you. There is not a bank in this country, not one, that makes less than 400% more than you do on the deposits you leave there. The average, according to BauerFinancial.com, everything we do is fact-checked. BauerFinancial.com, you can see there's not a bank in this country that makes less than 400. Most make closer to 1,300% more than you do on the money that you were taught to leave there. Do I have your attention now? Well, I hope so, because now it's time for you to become the bank. It's time for you to learn what that one change is that I mentioned earlier that some of you have even forgot. Because remember, all we're doing is changing where the money goes first, and then we're adding one step. So where's the money going to go first? What's that magic machine that we're going to use to move our money? Because it can't be a traditional bank. Remember, they're in control. We need control back. So here's what the wealthiest families in history have figured out. This was pioneered by the Rockefellers and the Rothschilds, along with some bankers named J.P. Morgan and the Stanleys. You can look that up. They wanted a better place to store their wealth back then. Even though they were bankers, they didn't trust banks. And, well, how can you when banks are going defunct left, right, and center right now? It was the same back then. During the Great Depression, lots of banks went belly up and lots of people lost money. So they wanted a better place to store their wealth. And what they found is the most secure and stable financial institution way back then. And that same secure financial institution is around today. And here's what it is. This machine where you're going to put your money is the same place they've all put their money, and it is nothing more than a dividend-paying whole life insurance policy from a mutually owned life insurance company. And why would we do that? Well, let's just start with that's because that's where the banks put their money. Isn't that pretty funny? I just told you the wealthiest families in history, even today, have their money in whole life insurance policies, and they took control of their money. I mean, the Rockefellers took it to a whole new level with trust, but let's not go there. They all use the same vehicle, a whole life insurance policy from a giant mutually owned life insurance company. And in the age right now of banks going defunct and having trouble and cracks in the foundation all over, when you look at insurance companies, they actually have all the money. The insurance companies are the ones financing those buildings that have a bank's name on them. They're lending the money to the bank. That doesn't seem right. Shouldn't the bank be lending the money to the insurance company? Yeah, but the banks don't have the money. Remember, banks don't really have money. They have your money. Insurance companies, well, they have the money. It's kind of like Arby's, right? We got the meat. Well, insurance companies could do the same darn commercial. We got the money. They do. And banks know that. So banks are the number one purchasers of whole life insurance in the world. Don't believe me? There it is. FDIC.gov. And this is old. This is as of 2021. These numbers are significantly higher today. But these are just the top 5 banks in this country. You know them: Bank of America, Wells Fargo, JP Morgan Chase, US Bank, PNC Bank. Can anyone read that number at the bottom? $75 billion of their tier 1 capital is sitting in whole life insurance policies. Now, because banks are institutions, they can't just buy life insurance. They need a body to insure. They need an insurable interest. Well, let me ask you another question, and now this will make some clarity. When you walked into the bank, how many vice presidents did you actually see if you were paying attention? Now, next time you go in to get your dum-dum sucker from the bank, you will pay attention to the name tags and how many of them are vice presidents. See, when the bank promotes an employee to a vice president, that employee, that vice president, is now an executive of the bank, which gives the bank an insurable interest in that VP, which means they go out and they buy a whole life insurance policy to then back everything they're going to offer to that employee. What are they going to offer? A deferred compensation plan, a fully paid up life insurance policy. Some of you are bankers on here. Some of you work for the bank and you're like, oh yeah, I do have a fully paid up life insurance policy. It's 50 grand or 100 grand. And if you're real high level, it's 250,000 bucks. How do I know? That's all public knowledge, folks. So that's why banks have so many vice presidents, because they need to put as much of their tier 1 capital, the most valuable money they have, in whole life insurance. Yet if you go in and talk to the bank advisor, they will tell you not to put your money in whole life. They will tell you to put your money in a VUL, a brokerage account, or some CD or something like that. So why doesn't the bank tell you to put your money in the exact same place the bank puts their money? Well, I'll leave that for another day, and I'll let you just let that simmer in your mind a little bit, because it is pretty strange that they don't teach or do what they don't tell you to do what they actually do with their money. This I did just for Christy's group. You all understand velocity. So I want to give you just a little history in the annual spending, the pattern of spending that we all go through. This should look familiar. We're just going to use a dollar, right? For every single dollar that you earn, out of that dollar, 20 cents of that dollar goes to automobiles. That's payments, gas, upkeep, 20 cents. Okay, just remember 20 cents goes to automobiles. Housing, out of every dollar you earn, 30% of that dollar goes to housing. Okay, 40% or 40 cents of every dollar goes to everything else. Going out to eat, credit card payments, all the other stuff that you do, diapers. And how much is left? Well, I kept it simple and just did 10%. If we add all those numbers up, you have 100%. So that's how your dollar is broken up statistically. Okay, yours might be a little different, but as a statistic, that's how it works. So just think about that. How much money are you saving? 10%, and that is far more than the national average right now. We're down around, I think, 4 or 5% right now. So my numbers are old here. If you were saving 10%, you're doing really good. But last time I checked, we got record high on credit card debts, which is why Christy's so popular, because she shows you how to get rid of the worst debt you've ever had, credit cards, okay? And if you did that, you then get to take back the velocity of money. Well, I just want to show you exactly how that works with the infinite banking concept. You see, if you apply what you're about to learn and what I've been teaching you, but you just don't know you've been being taught, because I had to get through the mindset stuff first, you will understand that the fastest way to build wealth is through your own debts and expenses. You want to build wealth? Take back the money you're giving away, because you're giving 20 cents away on the cars, you're giving 30 cents away on the house and all the real estate stuff, and 40 cents away on everything else. And everything else is usually on credit cards, and you're only keeping 10%. So let's reverse engineer this, and let me show you how this really works and how you take the velocity back. First off, we start with 10% that you're saving. We already know 20 cents of every dollar goes to automobiles. And of that 20 cents of every dollar that goes to automobiles, if you took back the banking functions in your life, if you were the bank and you bought the automobile and treated your money the same way you would treat the bank's money, which I'm going to show you exactly how to get all the money back for every single car you buy, drive, and own by doing just what I'm telling you here, you could take back roughly 5 cents of that 20 cents. So now, where would that 5 cents go if you didn't have to pay it to somebody else's bank? What would go to your bank? So now your savings goes up. You literally just increased your savings by 50% just with your car. But we're not done with any of that, okay? So now we got to go to housing because this is an even bigger number. How many of you have actually looked at your mortgage statement recently? Any of you? Because I bet you at Any Money, the majority of the people that are going to see this video have either refinanced or bought a new house in the last 7 years because we've been at historically low interest rates. So it's a strong probability that the majority of you have refinanced your house. And you all pat yourself on the back. You're so thankful that the bank gave you those low interest rates. Maybe even tout the Fed and say, hey, Fed, thanks for lowering interest rates. Okay? But what you don't understand is even though you got a low interest rate, let's just use 2.5%. That'd be a really good interest rate on your mortgage. If you look at your mortgage statement, you will find that the interest rate means nothing for how much money you're paying out. Because every single payment you make on that mortgage in the first 7 years, roughly about 80 to 85% of that payment is going to interest. Because the bank has figured this whole thing out. They've done the math. Yeah. They've understood that out of that 40 cents, 30 or 25 cents of that 30 cents, 25 cents of the 30 cents is all interest. And they got you because they know that the cycle is every 7 years. So they front load the mortgage. They take back, they got the velocity going. All the interest is going to the bank. How many of you have ever taken a mortgage out and then a couple months later you get a letter in the mail saying, Bank of America is no longer servicing your mortgage, now it's XYZ Bank, right? You've gotten those. What did they do? They sold the mortgage. They sold the mortgage because all the value is in the first 7 years. Who wouldn't want to buy that? See, Bank of America gets all their money up front. It's a game. You're losing, they're winning. They're laughing at you when they put a sign up saying mortgages fixed 30 years, 3%, and you line up down the street because they're getting all their money in the first 7 years because you are giving up the velocity. And if you just took back the banking function, right there, you took back 25 cents of 30 cents that you spend on housing just by taking back the interest. And the last one is everything else. And you probably put that on a credit card with the best intentions of paying it all back, but you're giving up 5 cents of that 40 cents to interest. So now all we did here, folks, is we took back who funded the car. Your private bank funded the car, and you paid your private bank principal and interest. You got to keep the interest. The house. In time, you found a way to pay back your house, or pay the mortgage off on your house, but you didn't stop making monthly payments when you paid the house off. You continued making monthly payments, but the payments went back to you in your private bank. And everything else, you paid off the credit cards, and you needed somewhere for that credit card money to go because you were so used to giving away every one of those payments to Visa, Amex, American, MasterCard. Get my credit card straight today. But you were so used to making those payments that now you don't have to make them. So where does the money go? To your savings. You see, the way to wealth, the fastest way with the least amount of wealth or least amount of risk is through your own debts and expenses. Sorry I spent so much time on that, but I just think it's so relevant for what you're being taught by Christy, because this is the velocity you're losing to, and this is how you take it back. And all I'm going to do is show you how taking it back looks. So this right here is a real client. This is a real whole life insurance policy that was designed to be used for the infinite banking concept. So this client's name was really Kevin. So let's just use a real example because I just like using real numbers. I can make numbers up. I can do fake illustrations, but I just like using real ones. Kevin was a young man. He was 38 years old when we met him. He saw a presentation just like this. After he got done with it, he said, I need to start my own banking system. How do I do that? He got on the call with one of our money mentors, and we talked to him, and we found out Kevin's a real estate investor. Early on in his career, but he'd been saving up some money. So he had about 60 grand saved up in his savings account, and he was earning pretty much zero at that time. So he said, I want to take that 50, I want to take 50 of the 60 because he wanted to leave some aside for an emergency, 50 of the 60, and I want to put it into one of those specially designed whole lives. So right here, and I'm just going to show you right on the screen with my cursor, if you can see that, there's 50 grand. All he did, folks, if you can see in the screen, he took the money from the left pocket, which was his traditional savings account, and he moved it to his left pocket. Right pocket to left pocket, made one change, and where that money went first. And he put it into a specially designed whole life insurance policy where he earned a guaranteed interest rate plus dividends And I'll get into the rest and show you what that looks like. But then he wanted to continue saving money. He was saving about $500 a month, so he changed where his savings was going. We couldn't get all 500 in, but you can see we put $491.25 a month in. So if we could just fast forward to the end of the first year, Kevin put 50 grand in all up front, which means that 50 grand started earning compound interest the second it hit his account. And then he started putting $491 in every month, which is $58.95 a year. Everybody got that? Total amount he put in the first year was $55,895. Now, what I always like doing is getting the bad news out of the way first. Here's the worst part about what we do by changing where the money goes first. So this is the worst part about this. Okay, you ready? Kevin put $55,895 in his policy, and Kevin could only take $51,554 out. There you have the bad news. He put $55,895 in, and he could only take $51 out. But now, check this out. Christy, can you play along with me for a little bit? Let's just say Christy needed a loan for 50 grand right now. She needed it to market something or buy a piece of real estate, whatever. She needed 50 grand, and she was willing to pay 12%. So Kevin goes into his policy and clicks a button and takes a loan for 50 grand from his policy and gives it to Christy. So remember, he started with $55,895, and he took 50 out and he gave it to Christy. Christy, how much money has he got left in his policy earning interest and dividends?
The whole amount.
That's right. But see, that to you is just like, duh, the whole amount. But to some of the listeners, they're like, wait, no, that can't be. He had $55,895, but he took $50,000 out, so he should only have $5,895 earning interest if they're thinking about this like they're banking. You see, folks, this is the magic. The whole life insurance policy has something that no other vehicle on earth offers. It gives you the ability to save and spend at the same time. But I don't like using the word spend. I like invest or lend. Okay, be the bank. So he had $5,500 in there, of which he could take 51. He took 50 out as a loan and gave it to Christy, and Christy paid him interest. And since he started his own banking system, where do you think he took the interest payments that Christy paid him and put it? Did he take it back to Bank of America and put it in their account? No. He took that interest that Christy pays him, he put it back into his banking system, which is this policy. So when he's doing that, he's paying the loan back, regenerating the money. But he was still earning interest and dividends, and his policy paid him 5.65%. That was his interest and dividend that he earned, 5.65%. Some of the policies are 5.2, some of them are 6. His was 5.65. There's 4 different carriers that we use, actually 5, but we really only use 4. His, 5.65. So he's earning 5.65% on the full amount, but the insurance company lent him 50 grand. But why would they do that? Well, let me explain that. You see, in a whole life insurance policy, the insurance company makes you 2 promises. Number 1 promise, they guarantee you an interest rate. His policy, 3%. He's guaranteed for the rest of his life to never earn less than 3% guaranteed interest rate, contractually obligated, okay? But the second promise they made to Kevin, and they would make to you is same, is when you die, there is a death benefit paid to your beneficiaries. We all know that that's what life insurance is. But what we don't know is that when we're living, the insurance company, as long as the policy is built the proper way, which is what we do, the insurance company will allow you to take a loan from your policy, which is essentially the insurance company giving you part of your death benefit while you're living. So that 50 grand that Kevin gave to Christy, guess what that was? 50,000 being advanced of a future payable death benefit. And when they give that loan, that means that Kevin's money never has to leave the account, because Kevin's money, the 51,554, just serves as collateral. The insurance company likes being in first position, like Ricky Bobby's dad said. So the insurance company says, hey, Kevin, you got 51 grand in the policy. Awesome. You can take 51 grand because we got that as collateral. So no matter what, if you don't pay us that money back, we're collateralized, and we got to pay the death benefit someday, so we're just going to subtract it from your death benefit. Good to go. So Kevin just got a loan from an insurance company that he never technically has to pay back because it's just an advance of a future payable death benefit, and he got to earn interest and dividends on an uninterrupted basis. This is the magic. This is why those wealthy families use this, folks. It is the only way you can tap into uninterrupted compound interest, the ability to earn and use at the exact same time with no interruptions. This redefines compound interest. Albert Einstein said it was the 8th wonder of the world, or some say he said that. He said it was the most powerful thing in the universe. Those that understand it, earn it. Kevin. Those that don't, pay it. Sorry, Christy, I made you the payer here. Okay, so you guys get it. One's earning, one's paying. It all happens at the same time. Kevin makes money twice because Here's the thing I didn't tell you. When Kevin got that loan from the insurance company, his money still earned 5.65, but they charged him 5% interest on that loan. That's right. They don't give free money. Okay, they're not dumb. So they charged Kevin 5% interest, simple interest. And I'm not going to show it in this presentation, but I got another video that shows it. Because he's paying simple interest and earning compound interest, he's making, what did I say banks make? A spread. But what happens every single year that goes by when Kevin's earning uninterrupted compound interest? Wouldn't his spread go up? Of course it would. Because if you're paying a fixed 5 or 5%, simple, and you're earning 5.65, but you're earning 5.65 on a higher amount every single year, of course your spread goes up. Which is why I have this slide before we get into showing you how to get all the money back for every car you're going to buy, drive, and own. Because right here, if Kevin took the 50 grand out, he's still earning interest on the full 51,554. But the second year, he put 58.95 in. And because he was earning interest and dividends on the full amount, his 58.95 grew to 71.41. This is right off the illustration, folks. Okay, which means he made $1,246 on that deposit he made. Okay, because of the compounding interest. So that was, if you did the math, if you took $1,246, the amount he made is true net gain. Okay, some people are like, oh, that's not what he made. There was a cost for the insurance. That's already netted out, folks. I can't show it without showing you the cost. The insurance company absolutely charges you for the death benefit. They're not a nonprofit, but he made $1,246 net. If we divide that into the amount he put in the second year, which is the right way to do it, because the amount he put in the first year, he already lent that money out. It's already out there working for him at 12%, because Christy took a loan from him. So when we divide 1246 into 58.95, we get a 21.14% cash on cash return. And I don't know, you guys can look at the numbers, but there we go, 26, 54, 115, 191. Are any of you complaining that the insurance company charges you 5% when they're making 21, 26, 54, 115? I mean, is anyone complaining when they're making 191% cash on cash return when the insurance company bills them for 5%? No, never. And I'll show you the math behind that. I just wanted to, again, show you how this works and why the wealthy use this. This is not some, hocus pocus thing. This is just math. That's all this is, mathematics. And I'll prove it with the next slide, because now what we're going to do is we're going to do something really fun. Get my computer to work. Come on. Here we go. That's a nice car, right, Eleanor? Wouldn't you like to know how to get all the money back for every Eleanor or any car you ever buy, drive, and own? It's so simple. I already gave you the magic formula for how to do it, but now I'm just going to show you the math. So before we get into this, the first thing we all have to identify is that there's 4 ways to buy a car. So let's go through them. Number 1, you can pay cash for a car. And if you were going to pay cash for a car, you'd have to save up enough money in the bank to pay cash for the car, right? We all have either done that or know somebody that's done that. The second way, you can finance a car. You can go to any bank out there and they'll give you a car loan. They'll charge you principal and interest. And just so you all know, car loans right now are about 7.79% on the lowest. That's what you can expect for a used car loan right now. Okay, so you pay principal and interest for the car. The third way you can buy a car is you can lease it. I think it's one of the worst options because you're just making monthly payments of principal and interest. And then after the 3 years of the lease term, you just give the car back. You don't even have anything. And the fourth way you can get a car, I bet you didn't know this, but you can steal a car. Now, don't steal any cars, but you can. And it is a way to obtain a car, but you might end up spending some time in this beautiful place called prison. So don't do that. So now that we've got the 4 ways to buy a car, let's go through and let's be the bank. And let me show you how to get all the money back for every car. So we're going to combine 2 of those different methods, the first and the second. We're going to combine paying cash for a car, which means you have to save up. So in this example, I'm going to show somebody saving up $10,000 a year. Don't get caught up in the numbers. Add a 0, subtract a 0, whatever you want the numbers to be, that's how much money you're going to save, okay? Doesn't matter. We don't make the amount. I just use 10 grand as a simple number. So we save up $10,000 every single year in the effort of buying a car. But we don't save it in a bank account. Where did I tell you we're going to change where our money went? It's in a specially designed and engineered whole life insurance policy. You notice how I keep saying specially designed and engineered? Let me hit that real quick. This is not a normal whole life. It is designed and engineered to do what you're seeing. Because if you put your money in a regular whole life, it will not work this way. It will not have cash value like this. You will not be able to put money in and immediately take the money out in the first 30 days. A regular whole life will have 0 cash value in year 1, 0 in year 2, and a little bit in year 3. Hardly worthwhile for what we're talking about. But because we designed these policies backwards and upside down, we put the lowest death benefit on, which reduces the cost, and we put the max amount of money into a rider called a paid up additions rider. Not getting technical with you, but that's how we do it. What that does is gives you the immediate access to your capital. You saw Kevin's, he had 51,000 of the 55. This example is, I made this one intentionally really bad. You put 10 in and you got 5873 you can use in the first year. But I'm showing you, it's not about the growth or how much you have access to, it's about the process you're going to do. And in order to do that, in order to give you immediate access to your cash value, it requires somebody to give so that you can get. To build the policies this way, it requires us to take a 60 to 90% cut in the commissions we get. Your brother-in-law that tried selling you a whole life last week, they're not going to do that. The financial advisor you work with, when you tell them about this, they're not going to want to cut their income or their commission down by 90% just so you have 90% more money to use the next day. Just trying to get you to understand that this is not a normal whole life. But if you're going to buy a car, in this particular example, 3 years after you buy the car, you would have saved up $29,204. Take the $25,000 for the car purchase I'm showing you, plus the cash value, the $4,204. That's $29,204. But we took a loan for $25,000, like I explained, to buy the car. Now, just let's check your knowledge and see if you're pacing with me. How much money is still in your policy earning interest and dividends if you took $25,000 out? That's right, $29,204. You guys are catching and following with this. But remember I said earlier, if you owned your own bank, you would never steal from your bank. You would treat your money the same way you treat somebody else's bank. So what we're going to do just that. We're going to figure out what the other banks are going to charge on a car loan. If they're charging 7.79, well, we could pay our bank back the same amount, or we could lower the amount. You're in control because it's your bank, which means you set the terms. So here, I just do an example of 6%. Okay, 6% on $25,000 would amount to about a $500 a month payment. So see the $6,000 car loan payment? We're going to make $500 a month payments back to your banking system, which is your policy. Meaning we're going to be paying that $25,000 loan down as we do. And if we just did this, because you're already doing this, but you're giving them $500 a month to somebody else's bank. If we just change whose bank we put on the check and we write your name instead of their name, this is what happens. Over 7 years, we put $70,000 into our banking system. But we repaid the loan that we took for $25,000 at a rate of $500. So we paid $30,000 back to our policy as loan repayments. So 70 plus 30 is $100,000 gross that we put into our banking system. But we did buy a car, so we took $25,000 out to buy the car. So our true net injection into the banking system in the first 7 years was $75,000. Everybody can see how I did the numbers. But if we look at how much cash value we have back in the policy by the 7th year, you have $67,881. Plus you got the car in your driveway bought and paid for. So literally on the first car in this example, you managed to get 91 cents of every dollar back for the first car that you bought. I don't think anybody on here knows how to get 91 cents back for every car that they're ever going to buy and not have to sell the car, because the car's still in the driveway, but you got 91 cents back. Okay, but we never keep cars. We always buy new ones. A new model comes out, you bring it into the dealer and they say the brakes are gone. You should probably just look at the new ones. So what do? We buy a new car. So let's buy car number 2. Remember, the first car is in the driveway. Okay, first car we deposited $10,000 a year into our policy. But the second car, we're not going to make any deposits. Now, Christy knows this. You would never, ever, ever stop making deposits into your bank, because, I mean, why would you? But here, just for illustration purposes, I'm going to show you stopping the payments, or the deposits. I keep saying payments, but they're premium deposits. Okay, you stop making them. So we put zero money in, but we still take the money out for the car. Take 25 grand out, we buy our second car. You're earning interest on the full amount, the 51 plus the 25, even though you took it out. We're going to make the monthly payments back to the policy, just like before, and then we're going to add it up. Zero in premium deposits, $6,000 a year for 5 years is $30,000 we paid back to our policy in loan repayments. Okay, that's 30 grand minus the price of the car, because we took the money out for the car, 25. Our true net injection from years 8 through 12 is $5,000. $5,000 bucks. Okay, so how much did we actually earn? Well, I kind of put it up there, $23,592, but that's not the amount. Because year 7, you had cash value of 67. You put no new deposits in, but year 12, you got 91,473, which means your money through compound interest and recapturing the money you were giving away did earn 23,000, but that's not how much you made by buying 2 cars. If we go down to the bottom, the 75 plus the 5, that's $80,000. A net amount that we put into the policy is 80 grand. How much cash value do we have in year 12? 91,478. So how much did we make for buying 2 cars? $11,473. And you have 2 bought and paid for cars in the driveway. What's it going to look like when you buy the 3rd, the 4th, the 5th car? Really stinking good. This is how you get back all of the money for every car you're going to buy, drive, and own. But if it works for cars, what else does it work for? Boats? Yep. Planes? Yep. Trains? Well, if you want to buy a train, sure. Every purchase. Copy machines like this one I'm staring at ahead here. Every equipment or piece of, whatever asset you buy, if you buy it this way and you follow these rules, you will always get all the money back, because compound interest, mathematics behind it, never lies, and you're taking the velocity back of the money that you were giving away. So there's 3 rules, folks. Simple. Pay yourself first. I said that earlier, and I'm going to say it again. Change where your savings goes and pay yourself first. Number 2, pay yourself with interest. My gosh, don't steal from your bank. Don't be afraid to pay yourself back with interest. I do it, and I never, ever gripe, because every payment I make back to my policy for my cars, I can use the next day. I own the bank. So when I make a $1,200 car payment back to my policy, some people will be like, oh, that's crazy. It's not when you got the $1,200 back in your policy to use the next day your check clears. Pretty cool, right? So pay yourself back with interest and recycle and recapture all of the money that you were giving away. In other words, just like I mentioned earlier, if you were paying money to a credit card and you paid a credit card off using this, pay the amount you were giving the credit card back to this. If you were paying a car payment and you paid the car loan off, make the same car loan payment back to your policy. It's called recycle and recapture of your money. And it really, like we talked earlier, we always laugh. It's just velocity, folks. It's changing the velocity of where the money goes. If it works for a car, we already went over that. And the flow of the money, this is all it is, folks. This is where I'm going to wrap up the infinite banking piece. It's a circle. So in your mind, and I'll put it up on the board here because this is really cool with Riverside. I can kind of show it here and give that. All I want you to do, folks, is I want you to envision a circle in your head, okay? And this is the flow of your money. Your money is going to start here in the policy, okay? So we'll just call this the whole life. Your money is going to flow around the circle, and we're going to send it to work, just like I'm showing here. Money starts in the policy. This is a real example. This is one of the first things I did, Christy. When I first got started, I actually had, this is my second policy. I put 25 grand into the policy. And I immediately, in the first 30 days, took out $23,000 of that. Now, some of you are looking at this big blob in the middle called segregated bank account. Don't get confused. All this is when you work with us, we have you go to your bank and set up a second checking account. Yep, that's the segregated account. It's a second checking account that's only going to be used for your infinite banking concepts because we want books and records of your money. So when I took the loan from the policy for 23, I deposited it in my segregated bank account. Now, where did I want, you never take a loan from your policy if you don't have somewhere for that money to go to work. So back then I had debts. I had a debt. Why is this thing not working today? There we go. I had a debt with KeyBank. It's a local commercial bank. I had a line of credit. And I owed that line of credit $23,000. They charged me 9%. So I took the loan from my policy, my bank. I paid off their bank, but I took that 9% monthly payment, which was $289 a month, and I just changed the name on the check. I didn't write KeyBank anymore. It was actually a bill pay, so I just went in and typed, Chris Naugle. I wrote my name on that. And all I did is I had that bill pay go back into my segregated account, and then I set up an automatic swipe from that segregated account back to my policy. See, folks, this is just a circle. Money starts on the left, moves over to the right to go to work, comes back to the left. And in the middle, which I don't have here, in the middle is a spread. I made 9% on that $23,000. Why? Because I used to pay KeyBank 9%, and now by paying myself back, I make 9%. But once all your debts are paid off, what can you do? Well, if any of you are business owners, you might want a company vehicle. But wouldn't it be cool if you got paid to drive a company vehicle? I love doing this. Christy, I threw this in there. It's a bit advanced, but I thought it would be cool because who doesn't want to get paid to drive a company vehicle, right? So let me show you how to do that. Same principles. We're going to change where our money goes. We're going to set that segregated account up. But what we're going to do, just like I showed you just a few minutes ago, we're going to buy a car. It doesn't matter how much the car is. Use your own math, okay, whatever you want. We bought the car using the money from our bank. But since we have a company, and since the tax laws are pretty favorable for companies that use vehicles for business use, we are literally going to do what the banks and what all the car dealerships do every day. We're going to just lease that car to our company. Yes, folks, you can do this legally. Talk to your attorney, consult with your CPA. This is not difficult. You just have your attorney draft up a lease. Matter of fact, if you go to bankrate, we'll go to Google and type in lease calculator, bankrate.com will come up. Go in there and you can figure out how to calculate your lease payment. So that's what I did, and I had my attorney draft the lease up from me, Chris Naugle, from my banking system, to my company, Money School. And then all my company did is made monthly payments, lease payments, back to me, and I got to drive that car and get paid to drive it, folks. And, since we already know the outcome, what happens at the end of the lease term? Yes, you get all the money back for all the cars you lease to your company. It's the same mathematics, except for your company, the tax write-off for the payments. Yes, that tax write-off was taxable to you, so it's kind of a wash from a tax standpoint. So don't think of this as a tax play. Think of this as a velocity play, and also think of this as just a really cool way to make your money work for you and also get to enjoy it. So whatever that car is that you're looking at, this is a really cool way. I got a video on my YouTube that shows exactly how I did this with a G-Wagon, and it breaks down the mathematics of it. So this just is to plant the seed in your mind. And then obviously pay off the interest. But here's my favorite thing, okay? And this is kind of where I'm going to get to the meat and potatoes of it. When you've exhausted all the other things, you no longer need a car, all your debt's paid off, and you got all this money, and you're just like, what do I do now? Well, you become the bank and you lend money. I've created this thing called Private Money Club. Private Money Club is just like a dating site. Some of you have used dating sites, some of you have not, but let me just explain them. They're very simple. There's men and there's women, and then there's a community in the middle, and they come together, they chat, and you go off on a date, and maybe it works out, you get married, have kids, and all that good stuff. Well, one day I had sold off a lot of my real estate, and I had money. And I started thinking about this. I'm like, it's really difficult to be the bank and lend this money out. I got to constantly try to find new borrowers. So I said, why isn't there a dating site for money? Why isn't there just one place where there's two types of people? Because there's only two types of people in the world. There's people with money and people that need money, right? It's how the whole world goes around. People have money and people need money. And both of those two people have a problem. You see, people that have money, their problem is they want to make more. That's right. And people that need money, well, they need money to make more money. So I said, well, all right, why don't I just create a community, a website and an app that allows these two people to come together and be in the same place, communicate, chat, do a whole thing, create a learn section, create a whole bunch of really cool stuff. I did that 3 years ago. PrivateMoneyClub.com was born. And it is that simple. And some of you maybe even are young enough to know what Tinder is, but it's swipe left, swipe right. Yep, that's how the app works. You swipe left through deals. When you find one you like, you swipe right. It notifies the buyer or the seller if you're, or the lender or the borrower, whatever one you choose. And that's how it works. So I started lending money on Private Money Club. And here's how that would work. I take a loan from my policy for $23,000. I still got $25,000 in the policy earning interest. I lend it out at 12%, just like we did with that example with Christy. I take the interest from those interest payments that loan earns. I take them and I put them back in the policy. And on occasion, I want to go enjoy it. So I take a little bit out, okay, to spread, and I go and take my family to dinner, take them to Disney World, take them anywhere I want because I have created time. Because time is created by your money working for you instead of you working for money. You see, I finished up with this because I wanted all of you to see how simple this is. Every bit of what we went through in this, however long we've been doing this, is all about you creating more time. And to create more time, you got to find a way to make your money work for you. That's what the wealthy do. That's what you need to do. This and this specially designed whole life, I mean, it's just a stupid whole life, but it's designed so that it works and puts your money to work for you 24/7 until the day you die. And the day you die, a death benefit's paid to your family so they can then live a better life. And then also that creates generational wealth. That's all we did here, folks, is we just put your money to work like Kevin did. That being said, folks, that's what I got for you. I do have a bonus round. I don't know where I'm at time-wise because I built this presentation solely for this, and I didn't really time it. So if you want, I can show you like another bonus round, but that's up to you.
Go for it. This is beautiful.
All right, so folks, all I'm going to do now is I'm going to build on what we did. Now, this is something that we built for a client. Okay, we built it for a client because this client wanted to do everything you just kind of witnessed here. And let's see. So I'm just going to make this big so you guys can just see this screen here. All right. There's the circle. All right. This is just what we talked about before, but I'm going to show this solely in the context of being the bank and lending money out. You'll notice this entire thing references Private Money Club, which is a website. You just go to privatemoneyclub.com. You create a free profile. It's like every other social platform you've been on. Put a photo up, tell people what you want, and start going in and making money, because that's all people do on Private Money Club. They're there to make money. You're not there to go on a date. You're not there to go out, to a concert on the weekend. You're there to make money. So this particular person wanted to change where his money went first. So you can see here's his income, and here's where it went. His savings went into a policy. He then every year would take max loans out. He'd take that max loan, put it into his segregated account, and immediately find somebody on Private Money Club that's looking for money. He latched onto this really good developer called ROI Property Group. Okay, they're a huge developer, and they're always borrowing money, and they pay 12%. So he did that, and he takes the interest back into his policy or into the segregated account, makes the loan interest payments only to his policy. So again, there's your circle. Doesn't look like a circle here, but that's all it is. So now let's just go one layer deep and put numbers to this. His numbers were big. Again, he was a pretty affluent individual, had made some money in his life, had some money. So his amount he wanted to save was $440,000. Now I know this is a big number, and some of you are like, oh, I don't have that. Don't look at it that way. Because if you look at it that way, you'll never have that amount. That's how the universe works, folks. When you plant an idea in your head, you're right, Christy? If you say, I want $440,000 to deposit into the policy, guess what? If you never lose sight of that, you will deposit $440,000 in. But if you think you can't, well, then that's the truth. You won't ever have it. So don't look at this number as a bad. That's why this is a bonus session. I like using a big number because it gets you to really stretch what you're really dreaming for. Because, folks, we should actually add another zero on there for you because you're the 5%ers. So he takes this 440, puts it into the policy. Immediately, in the first 30 days, he takes his first loan for $348,996. It's probably about 80, I didn't do the math, but about 80-some percent, 88, 89% of the money he can take out. Puts it in the segregated account, lends it out at 12%. That 12% interest payment on 348 is $3,781 a month. Takes that money, puts it back into his segregated account, and then, just like here, puts that interest back in. And we do this year over year. And I'm just going to get to the numbers now. 440 goes in the second year, takes 381 out. Now, I want you to just notice one thing there. First year, he put 440 in and only could take 340 or whatever. Second year, puts 440 in, takes 381 out. Why more? Compound interest on an uninterrupted basis is why. Mathematics. Lends that money out. So now he's got $758,000 loaned out at 12%, which means now his monthly payment that he's getting from the ROI Property Group, lender or that borrower, is $8,216. So we did the math. His 1 year gain is $45,000. He has to give back. Remember what I was saying? Who complains about paying the 5% when you're making 45? So he's making 45. And he's giving $17,000 back to the insurance company, which we show there, which means his 1 year gain to reinvest is $27,000. So he takes the net and he reinvests that too. And he just keeps going on and on and on. But here's what it looks like. And this is the absolute worst part about this is the first couple of years. So let's just hit the first year, which is the worst year. He put in $440,000, of which he could take $348 out. It's not 100%, folks. I want you to be clear. That's the worst part. You're not going to have access to 100% of your money in the first year and not in the second year either, because you've got a death benefit. His death benefit is over, I think, $8 million. So if he dies, his family gets $8 million. There's a cost for that $8 million, and that's represented here, okay? So the loan interest he had to pay was $17,000, but he made money, so he had $38,777 left. So here's the PMC. He put that money to work, so his total gain was $45,000, and his average monthly cash flow was $3,781. A lot of numbers, but don't worry about it. Don't try to figure them out because I already did it. Down here, here's the snapshot. He deployed, 348, made 45,000, gave back 17,000 in interest, netted 38,777 right there. See the numbers now, which means his net proceeds were $415,693. But he put 440 in, so he lost 5.52% the first year. Sucks, doesn't it? So let's go to the second year. He does the exact same thing. I already showed you how this works, so we're going to go faster and faster, and we're just going to look at the snapshot. He took and did the same thing, lent the money out, took the interest and kept that money working for him. He made 2.46% net of cost of insurance. Some of you are thinking, that sucks. And maybe, by all intents and purposes, 2% return on your money does suck. But you see, sometimes you got to give to get. I give up commission so you get access to your money. Here, you're giving up a little bit of return in the first couple of years, but now look what happens. It's almost always the third or fourth year where the magic happens. He does the same thing, puts 440 in, lends 399 out. Okay, we'll come down to the bottom. So now he's got all that money working. He made 9.63 net. The next year, the fourth year, does the same thing, makes 17% net. Notice how the number keeps going up? It's not because he's making more money, folks. It's not because he's saving more money. It's not because his return on that loan is any more. It's still 12%. The difference every single year is math. It's compound interest working for you on an uninterrupted basis. That's all this is. Now, let me just stop here in the fifth year. 24%. That's a return I don't know a single soul out there that wouldn't love to get. This person had to wait to get that. But would you have given up 2 years, really a loss in the first year and a little bit of maybe potential gain in the second year to be able to make that kind of return? Most people I ask say yes. The people that say, nope, no way, I would have never done that. Perfect. It's very important for me to understand who my client is not so that I can understand who my client is. My client is not the person that puts $440,000 in their bank account, and at the end of the year, December 30th, goes back into the bank, takes $440,000 in whatever measly interest the bank gave you out of the bank, and then is holding the money, which is now taxable, okay, and says, see, I told you I could do it. You're not a good fit for this. But for everybody else, you very well might be. Now, hold on. Let's go past the fifth year. This is where it starts looking almost too good to be true, but it's not. It's just math. All we're doing, folks, is repeating the process over and over again. This might not be what you do, but it's just mathematically showing you this is what compound interest is. This is why Albert Einstein said, those who understand it earn it. Those that don't pay it. Look at this. Sixth year, 33%. Seventh year, 42%. 58%. The eighth year, 77%. The ninth year, 97%. The 10th year, net of cost of insurance, net of the 5% interest you're giving to the insurance company, net of everything. That's what he made. 119, 144. Okay, 12 years in, he's making 144% net return yearly. And it just keeps going. I mean, I stopped it there because it just starts to get to the point where most people that see these kind of numbers are like, that's not possible. This math proves it's possible because we didn't miss anything on there. There's nothing hidden there. It's straight off of illustrations. That's how powerful velocity of money is. That's how powerful you taking back control of your money is. And that's how powerful the infinite banking concept is. Christy, thank you so much for your time today.
Wow, that was awesome. Awesome. Anybody out there that is looking for the infinite policies, the PMC school, they have a school, let me say that, the Private Money Club. Awesome. So detailed the way these courses are set up to do Zoom meetings and just so informative, just a mine full of gold waiting there for someone just to take advantage of it. And I just had to bring Chris on and let him explain it, in the detail that he does so that you can understand what he's doing and what opportunities he's laying in front of you if you are interested in, one, infinite banking, or two, growing that money. He has just every opportunity you could imagine with investing your money besides putting it in the stock market where you're worried about losing your money. I think that's the biggest fear I had, was trying to figure out, well, if I put in $5,000, what's the chances that I'm going to be able to pull that back out? And I think all Americans have that inside fear of the what ifs. I hear them every day with, putting your money into a HELOC or a line of credit. What if? What if? So we have a little fear there, and it's a realistic one because it is a fact that the stock market goes up and down, and it's crazy. So I am just so tickled that you came on here to give us this information. I literally cannot wait until it airs through YouTube, because I know that people are going to get some questions answered, and now I will direct them directly to you. Very excited about that.
Well, it was an honor to be on today, so thank you, and I look forward to working with you a lot more in the future.
Well, thank you so much. And for everybody out there listening, please, I'm going to have a link below. And there is no better way to use your hard-earned money to pay yourself back. I mean, I do have one question, Chris. Is there a tax write-off? People are always saying, well, if I put into 401k or if I put into a retirement or the IRA or anything, I can write off for my taxes. How does that work here?
So you would never want to take a tax deduction on the money going into this, because then all the benefits would be taxable. So the cash value would be taxable. The death benefit potentially could be taxable. You can, in a business, have the policy be a tax write-off, but again, the back end, you're going to pay taxes there. The only way that it works from a tax deductibility standpoint is inside of a properly structured, irrevocable trust, and it's got to be a federal trust. So a lot of rules around that. But if the policy is owned by the corpus of a properly structured trust, then the premiums going into the policy are a tax deductible expense to the trust. That is the only way, but consult with your CPA or a tax attorney or a trust specialist if you're going to go that route, because there's so many rules around that.
Okay. And one more question that I keep getting is, when you make these payments back to yourself, are you literally making an additional payment? Say you're already doing a premium payment. Are you making an additional payment now?
Nope. All you're doing is you're just refilling the bucket. Because if you take a loan, so let's just say somebody's got $50K in their policy, they take $40,000 out. Okay. And then over here, the money goes to work. Let's just use PMC, and they start making payments back. So you took 40 out, which means the $1,000 a month you're putting back over here is completely independent of the amount you're putting in. Let's just say you're putting $10,000 in premium deposits in. This is the savings. Okay. So this is completely separate from this. This money right here, this $1,000 a month, is being generated by your money working for you instead of you working for money. So that $1,000 a month that's coming back over into the policy as a loan repayment, all it's doing is every month reducing the $40,000 outstanding loan that the insurance company is charging 5% on. So every month you're subtracting $1,000 off the principal, which means every month you're paying 5% on a lower balance. So this is going down and this is compounding up. That's how that would work. So this is separate from the savings.
Okay, so literally they're going to send you, I guess, however you set up to do the repayment.
Yeah, our team does all this for you. All you got to pick is, how much do you want to save? What do you want to do with that money? Is it cars? Is it debt? Is it boats or lending on Private Money Club? You pick how the money's going to go to work. We help you structure the loan. We help you structure the loan repayments. We build the map. So we always like to call it a map, just like a GPS. So we'll build your map and cash flow tools. Our team does all this for our clients. Okay, and there's no cost for it.
Okay. Yeah, I noticed that I was getting contacted because they're wanting to know how I want to spend my money. And I'm just now getting set up, and I'm doing a million other things right now. So I'm getting to that. But I am just, again, so thankful that you came on today. Very excited for any way that I could work with you in the future. And I just hope that all of my my clients and the followers on YouTube are very interested in infinite banking, and now they have a source. So thank you. Thank you again.
You're welcome. Thank you.